Welcome to the latest edition of the InterMarket Analysis Update. You'll probably notice right away this looks a little bit different than the videos that I usually post. I had a hardware issue over the last week and I had to switch computers. So I have to do all of this with take one, and I'm using a different setup in order to record the video. So please forgive me if I stumble over my words or I make mistakes or I jumble some things up. Also, you'll notice that some of the charts may be out of order. They didn't quite transfer over in a convenient manner, and it was really hard to be able to sort them. I wanted to go ahead and start recording this. So this is being prepared on Sunday, June 19th, and we'll go over how things look amongst the different markets that are out there. One thing that I will be posting soon in the next day or two is a video about the program that I offer. And so if you're interested in that, feel free to look that over and just do with it as you wish. So let's go back then. And boy, these blue colors sure do clash. Let's go back and go through the intermarket analysis for Tuesday, June 21st. The market will be closed Monday, June 20th. Let's look at valuation. First of all, we had a really nasty week last week, and the S&P really came down. These lines that are on the chart, these are trailing 12 months earnings. And this is based on that. And these are PE ratios. A PE of 20 is the red line. The blue line is a PE of 15. And the green line is a PE of 10. Usually when it's 10, that's considered inexpensive. When it's blue or 15, that's considered just about right. And when it's 20 or above, that's considered expensive. Well, the market has been way above the red line or the PE of 20 on the TTE basis. Excuse me, the TTM basis. And with the decline, we actually came below that. And this area down below measures the distance between the S&P and the red line. And we have actually been able to drop below that line. Here's just a historical, why is that popping up? Here's a historical chart just to show you how we have been valued at different times going all the way back to 1980 to give you some perspective on that. So let's look at growth versus value. And I have lots of different charts on that. And people often ask me, why do you have so many charts? I like to look at the same thing in different ways. Big charts, little charts, long-term, short-term, inverted, right side up, because you'll never know when you get some insight that maybe you didn't have before. So, and growth and value are kind of the two main areas of the stock market. So these are the areas that we really like to look at. This is just a growth index. No value here, just growth. And we have really been declining pretty much for all of 2022, where value has seen some recent weakness. That's kind of interesting, where it had been holding up and been really outperforming growth, but not lately. And here's a comparison between the two. On a relative basis, growth is still underperforming, even though it's bouncing up, and value is still outperforming, even though it's seeing some recent weakness. Here's another look, looking at some indexes. This compares the growth index with the value index and just shows that even though we're coming back up to the moving average, growth is still having a lot of trouble. This is an inversion of that same chart, just upside down, that just shows how value has been outperforming growth, even though it's seen some recent weakness. Here's an ETF, kind of showing the same thing. But if you notice on this chart, and if you go back to, you notice that we made a lower high on this chart, and we made a higher high on this chart. Some people might find that interesting. So that's why I like to look at different things. But this just shows how growth has been really having some problems lately. Here's an inversion of that same chart where it is now advancing. Then we look at the growth index against the value index ratio. And it just shows where overall growth has been underperforming. Then we switch over to the Crb index. This is the main inflation gauge that I use. And it just shows that we are in an uptrend. Even though we got knocked down a little bit recently, we're still above this blue line overall and in an overall uptrend. When we compare the CRB with the S&P 500 for all of 2022, the CRB has really been outperforming. And this is just an inversion of that same chart showing where the S&P 500 has been underperforming. Here's the Nasdaq 100 against the S&P 500, where the Nasdaq 100 continues to really underperform, even though it's bounced up a little bit recently. And here's the S&P 100. This is looking a little more encouraging, where we haven't seen this good of a reading in a while. It's not positive, but we were able to get back above this moving average. That's a 50-period moving average. For most of 2022, we have spent most of the time below this moving average. So that means the S&P 100 is underperforming the S&P 500. If we can see some improvement with this, that might help the overall market. Here's small caps. They had been holding up okay, but recently have really started to show some weakness, and they're still in an overall downtrend when you compare it to the S&P 500. The low volatility ETF, these are stocks that people like to get into when the market's been having trouble, and it goes down just like everything else, but a lot of times it goes down less. And then we look at this on a ratio basis, and it shows that low volatility has outperformed. Doesn't mean that they haven't gone down. They've just gone down less than some of the other growth stocks that are in the S&P 500. Here's the Dow Jones Composite average, which is the Dow, the transports, and the utilities all together. And it shows that we are in an overall downtrend. Here's Dow theory, looking at just the Dow Jones right here. Here are the transports, which are also showing weakness. And one thing is utilities have really been doing quite well, but look at how they've really gone down recently. So they're starting to have some real trouble too. Here's a longer term look at Dow theory, just to kind of get some perspective on a longer term basis here. When we compare bonds with the S&P, bonds are starting to pick up a little bit, even though stocks have outperformed bonds, or to put it another way, bonds have underperformed stocks. But we're seeing a little bit of recent strength, and we might be seeing a golden cross here. On a monthly basis, stocks broke out of a really long-term resistance level going back to the year 2000 and broke above that. Well, now it's coming back down. This potentially could act as support if we continue to decline. Junk bonds have been performing kind of like the market overall. When the stock market goes up, junk bonds tend to go up, and people get into these because they're seeking a higher yield. Even with interest rates going up, it's way below inflation. And so sometimes people need to put their funds at more risk just to get some kind of a reward or a yield that seems attractive to them. And here's a ratio between junk bonds and bonds themselves, and it just shows how junk bonds have really outperformed bonds, meaning the treasury bonds. Another thing we want to keep an eye on are these high leverage loans. If we're running into some difficult times, we would probably see this really start to come down as well. And we have been seeing some problems as of late, but we're also seeing problems in the overall market. Energy has been the place to be in 2022. Well, this last week kind of wasn't so good. We saw a real decline in energy when compared to tech, because tech used to be the cool place to be. We came down to this moving average, and can we bounce off of that so that energy can regain the leadership role that it's been having? Staples, these are the things that you have to have. They've been seeing some recent weakness as well. And then the tech sector has also been in a real downtrend. And this is the real growth area that people like to get into. When you compare the S&P with the 10-year treasury yield, it just shows that as the S&P has been going down, yields have been going up. So the S&P is really underperforming. And then looking at growth stocks against the 20-year bond ETF, they both have been having trouble. Growth has been down and bonds have been down, but overall growth has been down even more. Looking at energy against the SPY, energy has been the real strength, even though we've seen some recent weakness. When you compare technology to the 10-year yield, it just shows that technology has really been underperforming as interest rates are going up. Here's comparing the tech sector, which usually is where people like to go. It's been really underperforming the S&P. Discretionary, the things that make life kind of fun, and we compare those to staples, the things that you have to have that aren't necessarily all that much fun. Discretionary has really been underperforming for all of 2022. Looking at gold. Now, in this past week, gold's kind of just sat there. And I was actually watching or listening to a podcast about a week ago where they had a gold expert, and they asked him, how come gold isn't going up? And his answer was, I don't know. It should be going up. The only thing that's really going up right now is the US dollar, and it's a fiat currency. And a lot of people think it's going to fall apart at some point in the future. But at least right now, it's kind of the place to be when you compare it to the euro and the Japanese yen, and even to gold. And cryptos are having a lot of trouble right now. But when you have somebody that really studies this, that gets confused about what's going on, that means there's really some confusion out there. But even though we had a real decline in the S&P and gold kind of really didn't do very much, it's still outperforming on a ratio basis. And then staples against discretionary. These are the things that you have to have. And these are the kinds of stocks that people get into when the economy starts to show signs of trouble. Gold against the US dollar, just showing how gold has been really underperforming because the dollar has been quite strong as of late. The 10-year yield against treasuries just shows how interest rates have really outpaced the tech sector. And here's our intermarket analysis chart showing how oil had been doing great, but has recently declined. The dollar is the other asset that's up so far on the year. Gold's up just a little bit, where stocks and bonds are negative, going back to the beginning of 2022. Let's look at some correlations. We have the S&P against the 2-year yield, and they've had a really strong inverse relationship where when one goes up, the other goes down. Interest rates have been really going up, and we've been seeing the S&P going down. Well, they both declined, or they both advanced, or they both went sideways over the last couple of days. And so we're seeing this relationship lessen just a little bit, but it's still a really strong inverse relationship. Here we compare the S&P 500 to the 10-year yield. They also have a really strong inverse relationship. As the S&P is going down, that usually means interest rates are going up, and vice versa. Here's the S&P to the US dollar. It also has still a pretty strong inverse relationship. And that's been part of the reason for stocks really struggling. The dollar's been going up, and that's really put some headwinds in front of stocks. If you want to watch some things during the day, watch what the dollar index is doing. Just as an example, on Friday, it looked like we were going to have a monster open. We were really down on Thursday. The markets are really negative, and it looked like maybe we were going to bounce. And the futures were looking really good. They were up over 1%. Well, I also was watching the dollar before the market opened, and the dollar was up pretty strong too. And as we got closer to the close, the dollar maintained its strength, and in fact, actually gained a little bit as the futures started to come down. And by the time we opened on Friday, it wasn't all that big of a deal. So what I'm saying is keep an eye on the dollar index. And if it's really going up, that could put some pressure on stocks. Now, there are times, looking at this chart, when they don't really move in any kind of a correlation at all. But right now, they're in a pretty strong inverse relationship. So we'll just want to keep an eye on that. Here's the correlation to oil in the S&P. It's not really doing much because oil had a down week and the S&P had a down week. So this inverse relationship, we're more kind of neutral with this right now. Here's the tech sector comparing to yields. This is still a pretty strong inverse relationship. So if tech's going up, interest rates are down and vice versa. So what is positive right now? And I took this thing out of the other videos that I do because it hasn't changed in such a long time. But those areas of the market that are positive are energy, the CRB index, gold, interest rates, staples. You could even throw the dollar on there. Usually I don't include that. Those things that are negative, the whole list. And if you watch my videos on a regular basis, it's the same. I'm not going to read this list off to you. You can just pause the video and look at all these different things. But we're in a really negative environment and really having a difficult time finding out where's the bull market right now. It was in energy. And then about a week ago, everybody went, oh, I think I'm going to get in energy. And now, poof, it was down 10%. Oil dropped 10% in the last week. So where do you go to find some kind of a return? And that's why at the time I record this, cash is king. So thank you. I hope you have a wonderful week. I hope you're having a nice 3-day weekend. Look for that other video if getting more involved in the things that I do does have an interest to you. And I will prepare the next video next weekend.